Can I start my
Yes,
presentation?
we are waiting for you.
Okay. Um, the topic of my essay is the uses and benefits of derivatives manage risks. Often the risk is accepted by us as something given. The project has uncertainty of future cash flows, and that's it. Profitability can be affected by changes in demand, costs, interest rates, and a huge number of other factors. But why do firms have to worry about risk? Why manage risk? It is important to remember that hedging solely to reduce risk cannot add value. First, that's because it is a zero-sum game. Risk Risks are not eliminated, just shifted to some counterparty. And second, your shareholders can also hedge by adjusting the composition of their portfolios. So they will not reward the firm for doing something that they can do perfectly well for themselves. However, there are two reasons why risk reducing transactions can make sense. First, hedging risks when it is practical to do so can make sense if it reduces the chance of cash shortfalls or financial distress. Second, in some cases, hedging can also make it easier to monitor and motivate operating managers. Actually, almost all firms use financial transactions to some extent to manage risk. For example, according to a survey of the world's 500 largest companies, 83% of the companies employ risk management to control interest rate risk, 88% to control currency risk, and 49% to manage commodity price risk. Um, Besides ordinary insurance, financial managers use tools that are specially designed for hedging. These are forwards, futures, and swaps, with options known as derivatives. And a forward contract is a preliminary agreement to buy or sell an asset in the future. The future price of the transaction is fixed today. Firms also hedge with swap contracts. Some of the company's cash flows are fixed, while others depend on interest rates, commodity prices, exchange rates, and so on. These characteristics do not always match with the desired level of risk. Swaps allow firms to change their risk in these ways. Um, there are also ways to reduce the interest rate risk. Let's imagine that some firm has some asset that generates some positive present value. If interest rates increase, the present value of the payments falls. If the interest rates decrease, the present value increases. Thus, the asset exposes the firm to the interest rate risk. The firm decides to issue an offsetting debt liability of the same value. The trick is that the firm has to design the debt issue so that any change in interest rates has the same impact on the present value of the assets payments and the present value of the debt. The first way to accomplish this is to issue debt requiring payments exactly the same as the cash flows of the asset. In this case, the asset's payments will exactly cover the servicing of the liability, regardless of future interest rates. The second way is more convenient and therefore more often used: to issue debt with the same duration as the asset payments. If the durations are matched, fluctuations in interest rates will have the same impact on the present values. To conclude, today derivatives are used by some companies for speculative purposes rather than for risk management. And although the possibility of speculating derivatives is undeniable, these tools are very useful for the financial system. Thanks for your attention. That's all.
Nikolai?
Yes.
Yeah. Go forward, please. Move forward. Move. Okay. Where did you get these numbers?
This is the numbers from the survey of the Swaps Association, international swaps. I don't remember the name of the association, but that is the survey of 500 largest companies.
Okay, Nicola, when you make a statement and you provide figures, just remember that you have to mention the source.
Okay, I understood. Okay.
Okay, this is first question. Move forward, please. Forward. Okay. There you, well, match duration, you need a space, no?
Yes, match duration, that means that...
No, Nikolai, you need a space between match and duration.
Okay.
First of all, but this is not even important. But are you sure that you need to match just the duration?
Yes.
You're sure?
That is just the theory from corporate finance.
Yeah,
How?
But maybe you missed something there. What else should be matched? The duration is fine. And then? Nick? Nick? Kirill? Joseph? Anton?
Can you repeat, please? We understood that problem is not in duration, yes?
Nikolai, what you said before?
Yeah, I said that in order to reduce eliminate interest rate risk, we should issue an offsetting debt liability that should have the same value. And if we match the duration of our assets payments and liability debt payments, if we match the duration, fluctuations in interest rates will have the same impact on the present values. So we eliminate the risk.
So just duration?
That is the second.
No, I'm talking about the second, Nicola.
No, and the first way is
No. Nicola, it's clear. We talk about the duration, so it's just that we need to match the duration. This is what you studied. What is the duration?
What is the duration of the asset?
Yes.
Um, That is the weighted duration of all its payments.
No, it's not. The duration, you cannot say the duration is the weighted duration. You cannot use when you define something, you cannot use the same words. So if I ask you what is horse, you cannot say that a horse is a horse.
We understand, we know what is the duration of the payment, cash flow payment now and in the future.
Nicola, that's fine. You said that many times. It's fine. But now I ask a different question. What is that duration? What is the definition?
I understand what is it intuitively, but I can, but I cannot tell you the strict.
It's okay. It's okay. Nick, please specify what you mean.
So you've asked what is the duration in the context of an asset. So it's the lifetime of this asset, while this asset can be sold and can be bought. So while it has some value in it.
No, that is the time to maturity then. No, Anton. That is time to maturity. It's not duration.
Okay, it's the dimension of time.
Time of what? Because also maturity is time.
Duration is just about the time. It's not according to any.
No. Sorry?
Maybe some sort of measurement still that considers the maturity of the asset.
And then it's time.
And then it's
The maturity is time. But what is the duration? Okay, so the duration, you can think about the duration in two ways. One is the weighted cash flows. So weighted by what? Weighted by the time in which you will get the cash flows. So this is the first definition. The second way to think about the duration is the first derivative with respect of the asset, with respect of what? The price of the asset with respect to what?
To time?
No. It's written in this slide, right at the beginning.
Present value?
No. Up.
Interest rate?
Maybe yes.
Yeah, I have a question. That, Nick, Nicola, could you please repeat to Nick what I said?
The time dimension of the asset?
No. I said two things. Kirill, what I said regarding duration?
As I understand, it is a derivative of
what?
price of the asset
Price of the asset we expect
to the duration. No.
no. We are defining the duration. So is the first derivative of what?
Um, yeah, maybe of time until the
No. There is first derivative of what? Tanya? Joseph?
So I need to mention two parts what we talked about, yes?
What I said 3 minutes ago, what is the duration?
It's a measurement, as I understand, of interest rate risk that considers our asset to be mature.
No, not at all. Anton?
Duration, we said that it's a derivative
Yes, of
which
what?
for interest rate.
Of what? We
Ah,
do the derivative of what?
of short liabilities, maybe.
No. Of the security with respect to what? It's written in the slide. I told you before. Okay, Nick, you got it. So you can define the duration in two ways. Repeat. First way is the weighted cash flow. Weighted by what? By time. When you will get this cash flow. So this is the first definition. The second definition of duration is the derivative of the security, so the present value, with respect to interest rate. But this is first derivative. So what we miss when we need to do asset liability management, because this is what you want to do, Nikolai. You mentioned asset liability management. So either we do what you said, number one, or we match not only the duration, but also the convexity, which is the second derivative.
Yes, yes.
Yes? You get it?
Yeah, I got it.
Move forward, please.
That is the end of my presentation.
Yes, move forward. Next slide.
That is the end.
Okay, sorry. Because I could see 7 pages. So you closed in this way. Okay, sorry, Nicole, didn't understand that. Okay, so that's fine. Thank you. And then next one will be Tanya, no?
Just a second. Here. Can you see my presentation?
Yes.
So I'm going to talk about risks from central counterparties, and as we all know, central counterparties play a pivotal role in the financial system, and we know that CCPs reduce risks for the participants of the market by taking part in the trade between, as an intermediary part between the buyer and the seller by
Sorry,
guaranteeing.
Tanya, sorry to interrupt you. Can you put full view, please?
Yes, of course. So as I thought, the CCPs reduce the risk for the participants of the market as an intermediary part, and it is important to say that the risks are not only managed by them, but they also create new risks, and the new risks that they create are the systemic risk, the liquidity risk, and the credit risks, and these risks influence the financial system overall, and therefore there are used sophisticated risk management measures, and there is a requirement of attentive regulations from the side of public authorities. Therefore, we have to say that in the condition of constant changes, it is very important to adequately observe and detect these risks in proper time. The first risk I'm going to talk about is the systemic risk. CCPs also cause the systemic risk that refers to procyclicality in margins. Procyclicality as a term is related to the loop of feedback between the financial system and the real economy, and it can expand the existing business cycle and exacerbate the financial stability. And regarding the fact that CCP's management is firmly built on margins and exactly the collection and the calculation of margins, we need to understand that these margins cover the exposures that are faced with clearing member contracts that have been replaced with new ones. And therefore, in the case of sudden market stress, volatility, the initial margins requirements imposed on clearing members can rapidly increase. As a result, what we have a substantial liquidity stress because the clearing members put the pressure on the needs of margin requirements to post increasing amounts to CCPs, and they also put pressure on the fragile market participants, and they potentially destabilize them. And such kind of extended liquidity stress is called the systemic risk. And consequently, when a CCP, for example, protects itself from such kind of risk, it influences the market. So it is very important to be attentive so that this kind of influence wouldn't negatively affect the market too, because while they protect themselves. The second risk I'm going to talk about is the liquidity risks. So this kind of considerable liquidity risk can be caused by central counterparties from margin calls, default fund reassessment, and capital calls. And in this case, they usually they have the least strength to cope with such kind of risks, while large CCPs can concentrate and interact with major global banks. And this is why we have a requirement that participants need to provide highly liquid financial instruments or cash. And we have the result that this kind of requirement of cash or highly liquid financial instruments will rise when market volatility rises, and the liquidity needs of CCPs are inherently pro-cyclical. Moreover, we have the investment policy, and when we have the investment policy, there are also risks that come up. So the risk that follows the investment policy also suffer losses, and when the funds, for example, are not when the funds are not as mandated as they should be, they also cover losses. And moving back to the liquidity risk, the procyclicality appears again because when assessing, it is more complicated in the process of the assessment of the CCP's resilience. And rarely, but some large institutions may definitely fail. And an example of such kind of systemic liquidity risk is the COVID-19 situation. Why? Because there was a large increase in margin requirements during the extraordinary market volatility. The initial margins jumped from the point of $115 billion and rise to a peak in aggregate. And at the same time, the initial those were the initial margins, and the variation margins, they rose from the peak of $300 billion. And overall, we have this possibility that occurred because it was attenuated that the strong liquidity was positioned by the banks. Last but not least, we have the CCP, or the risk that is caused by the CCPs is the credit risk, and usually occurs when the CCPs fail, or when we have the risk of loss allocation or capital call risk. And they usually CCPs facilitate the management of credit risks for its clearing members, but by taking the risks from the participants, they not eliminate the risks, they absorb it to themselves. And generally, they have to improve the financial stability through multilateral netting or risk mutualization or margining. And we have the result that when a well-managed CCP can prevent excessive concerns about counterparty credit risk. And in this case, in the case of failure, the cleared trades need to be closed by the clearing member, by the clearing members, and the risk will also appear in initial margins and default fund contributions. And moreover, depending on the resolution, they might face new risks or problems because they have, again, the procyclical effect. And an example of this would be in Paris in 1973 and 1974 with the sugar futures. They had a six-fold gap in the values, and it had a collapse in sugar prices in November 1974. And I decided to also add information about not only the risk, but how to manage the cause risks. And we have the fact that CCPs are required to be financially stable, but they still have risks that they cause, and they have to protect themselves in a safe way, not to negatively affect the other participants of the market when eliminating risks. So therefore, in order to minimize the negative effect of, for example, systemic liquidity risk, they require liquidity from large banks or other market participants. Another solution is liquidity-focused macro-prudential stress tests. They are financial instruments that are used to prevent the problems. Also, it is important to operate with higher equity ratios. And if we're talking about the credit risks and minimizing the chance of detecting CCP's failure, we need well-designed default management schemes. And of course, we have to limit the risk-shifting incentives. And I'm finished.
Well, Tanya, this presentation is good. What do you mean by risk shifting?
The parameters that affect the risks. Well, and there is a shift, so there's a difference between the risks that was, so the influential parameters.
I don't get it. What do you mean by risk shifting incentives?
Is the transfer of risks from one party to another party?
Yes. So, for example, this is correct.
For example, the risk of default of somebody, of some participant of the market.
Well, yeah, we talk about, what is the title of this slide?
Managing risks from CCPs.
Okay, now you are to make an example of risk shifting incentives regarding
Insurance policies, for example, to hedging investment positions.
say it better.
The insurance policy could cover the risks, for example, in the case of hedging.
No, I don't get it. The topic is managing risk from CCPs. Okay.
No, the topic is the risks that come from the CCPs, and I just decided to go over and add the managing too.
Yeah. So there is a risk that could be used, that could arise from the using of the central counterparties. Correct.
Mm-hmm.
Good. And now let's go back to what you said at the end. The shifting. What is this shifting? What do we mean by this shifting?
For example, well, as I said before, I think I would stick to that example when we have the insurance, because it transfers the risk from a loss to the policyholder, to the insurer.
There is no insurance here. Where you can find the insurance?
Because that's the interaction between the two parties.
No, we have CCPs. Two
Okay.
parties is is a OTC transaction, no? But then we said to reduce the risk of OTC, then we introduce CCPs, correct?
Mm-hmm.
And now, what we mean by risk?
We mean by the risk shifts that the shareholder's equity decreases and the stake of the debt holder in the enterprise, it can increase.
Elvira?
I have an idea.
Arina?
Me too.
Nick?
Actually, at some point, I lost the thought.
Yes. Today you have a stable connection. Okay, Kirill?
Yeah, I also lose the what we talk about. I understand we talk about risk shifting, and what is it, and what are the examples?
Yeah, an example of this risk shifting incentives.
So, as I understand, risk shifting incentives is then, I don't know, some party may give some risks to another party, and so this is an incentive.
Mhm. And then what about these incentives in this case? Tanya, do you have the reference? Because I guess that you got from the reference, no?
Yes, this was from an American policy journal. I can send you the link after the presentation.
Yeah, what you need to do every time that you mention something is to make a list of reference. Because in this way, then you can try to get the original the original document. No? Well,
Okay.
okay, this is my first question. Then go back to the beginning, please.
I'm sorry, I didn't hear you. Where to go back?
Yeah, start from the beginning again. Go ahead. Where you introduce liquidity. So no, yes, this one. What do we mean by liquidity?
How fast we can exchange, for example, something in a trade.
Yeah. Exchange what?
Well, in a trade, assets, I don't know, something to convert in another financial instrument.
Well, in cash.
In cash.
Okay, that's fine. So this is good. And then go back, please. You this one. No, forward. Yeah. Why you say that is pro-cyclically? That this systemic risk.
Because when, for example, the CCP protects itself from the risks that occur, they affect by their solution, the market participants, and it goes like a cyclical. It goes like a cyclical effect.
But why?
Because they influence each other.
No. Is the first thing in bold. What you say in bold?
Involved in a trade?
No, in bold. You have something in bold. Can you see the first point, bullet point? What you have in bold?
I'm sorry, I don't understand you.
First bullet point. Can you see your first bullet point?
Yes, I see my first bullet point.
Okay, in bold, what is written?
Margins.
Okay, so that must be linked to cycles.
Yes, they are. That's because systemic risk referred to the pro-cyclicality in margins.
Exactly. So what happens? So if there is high volatility in the market, what happens?
The initial margin requirement. Well, I have this on the slide.
It's yes.
So the initial margin requirements imposed on the clearing members, they change, so they increase abruptly.
Exactly. That is the thing. Okay. So this is pro-cycle because of this, no? Because of the increase in the margins. And it can be the opposite, no? Low volatility and then less margins. But there is one thing that if you don't work in finance, you don't know. And then the thing is that volatility is linked to liquidity.
Mm-hmm.
And then maybe you see little volatility, not because there is little risk, but because there is little liquidity.
In this term, I meant volatility as a stress in the market. Because here the main idea was a sudden market volatility.
Tanya,
So in other words, I was talking about market stress.
that's fine. But what I'm trying to say is that normally people associate risk and volatility. But it can happen that there is risk and you cannot see it from volatility because there is little liquidity. It's clear what I mean?
Yes.
Okay, good. So next one. Tanya,
Yes.
please can you forward me again the presentation because I cannot find it.
Okay, I will.
Just a second.
I send it to you on both emails, but I will send it to you
Yeah,
again.
I cannot find it. Forward, please, the original message. Okay.
Okay, yes, I will forward it.
Thank you. So next one is Bulgakov.
He's in the other group.
Well, I didn't show up. So Kutsokovka.
She's in our group, but she's in our group, but she's not here.
Good. And then Miroshin.
He is in our group, but he has already.
He's already.
Yeah.
He's already good. Pokrovskaya.
Also, she was in the 2 weeks ago.
Potionov Andrei.
In the other group.
Anton Alexiev.
I think he has present his
so Anton. Yes, I found it. You are right. Okay, good. And then Suslova.
She's in our group, but she's not here right now.
Daria Tifiva.
One more time. Daria.
Цветкова.
Daria.
Цветкова.
Timofeeva.
Timofeeva.
No.
Timo, yes.
No, just a second that I copy here because your names are difficult for me. How do you see this?
Yes, she's in our group, and as far as I know, she told that she wrote you an email, and she's the main thing that she's not here right now.
Okay, good. Then Titov.
Yes, I'm here.
Good. Tanya, please, before the end of this class, try to send again the presentation.
Yes, I'm sending you right now.
Thank you.
Do you see my screen, my display?
Yes, go ahead.
Okay. Today I'm going to present a review on the topic of analysis of options and futures in Islamic banking. I have liked to make this theme because I believe that it is interesting, important, and actual now for the next reasons. Firstly, Islam is the key religion for many countries and is countries have a huge aggregated population. This population do not want to use financial instruments in its majority due to religion restrictions. It is a great problem for investors who want to invest in perspective economies and for governments which cannot change the rules on financial markets for different reasons, wanting to attract additional money for developing of economy. Second reason is that today it exists a lot of countries which are under sanctions of other developed countries. And for this reason, they cannot invest money in strong, good economies. For example, Russia is one of these countries. It is an awful situation for some countries and rich people in these countries. They want to invest, but their money doesn't need. And maybe for this reason, it should them think about investments in countries with Islamic banking, where the requirements to their status can be easier than in developed countries. The impossibility to use classical derivatives in financial practice originates from the Sharia laws. All deals, bargains, and transactions must match the next principles: Qimar, Maisir, Jahala, Gharar, and Riba. Qimar or Maisir can be translated on English as gambling. This rule means that financial instruments cannot be similar to the process of the game, which plays for money and causes an addiction. Maisir is totally prohibited by Islamic law on the grounds that the agreement between participants is based on immoral inducement provided by entirely wishful hopes in the participant's mind, and they will gain by mere changes with no consideration for the possibility of loss. Jahala rule can be explained as the unacceptability of information asymmetry about goods characteristics. The best example of this rule can be is the lemon and peach cars example. It is easily explained this principle. Gharar rule is very similar to Jahala, but it describes the risk in deals in business when participants or participant does not know about the final conditions of the deal. For instance, the ideal case which ideally describes the violation of this rule can be a very risky business where participants can have only a great profit or only a great loss. Riba is the prohibition to charge interest for financial operations. I don't think that it needs to explain because in the Christianity we have the same rule. All these Sharia laws make it impossible to use all futures, options, forward contracts, swaps, swap options, and other financial instruments in their common scheme, which are used in all countries. It needs to reinvent the wheel and to adapt some of these instruments to these countries. Islamic instruments that have derivative-like features or can be used to develop derivative-like instruments include Salam, Istisna, Arbun, Israr, and other instruments. I will tell about several of these instruments. First instrument that I would like to present is the Salam contract. So, Salam contract can be explained as a forward contract, which between two participants, except it differs from classical forward contract by that the buyer is obligated to pay the price of contract at first, and only after it the seller is obligated to deliver the good or a part of good. So I think that it is needed to explain it, and I have the example. So, for example, a farmer sells tomatoes to a buyer. Okay. However, they want to define fixed price in the future for tomatoes. They make a Salam agreement and they conclude that the price is $20 per ton. And the buyer wants to buy the 5 tons, which will deliver through 2 weeks. After the conclusion of an agreement, the buyer will have paid for 5 tons of tomatoes in the same moment. After that, the seller will deliver all 5 tons of tomatoes. Very similar to Salam contract is Istisna contract. So Istisna is another deferred sale contract in which the price is paid in installments as the work progresses in manufacturing or building an object. The Istisna contract will provide specifications for the item that the manufacturer will undertake to manufacture. In a typical Istisna contract, the Islamic financial institution funds the manufacturer during the construction of the asset, acquires title to the asset and to completion, and there immediately passes title to the developer on agreed deferred payment terms, or possibly leases the asset to the developer. So I know that it is a very difficult formulation, and I have the example also. The same example with farmer and buyer. So a farmer sells tomatoes to a buyer. However, they want to define fixed prices in the future for tomatoes, but they don't know the characteristics of tomatoes in the future. No, maybe it can be only red or only yellow tomatoes, and the price depends from this characteristic. So they make an Istisna agreement, and they conclude that the price for red tomatoes is $20 per ton, and for yellow tomatoes is $10 per ton. The buyer wants to buy 5 tons of any tomatoes, it is important, which will be delivered through 2 weeks for 2 weeks, which will be delivered every 2 days for 2 weeks. After the conclusion of an agreement, the buyer will pay for each part of delivery in the moment of the delivery and independence of tomatoes color. So every 2 weeks for each part of tomatoes. The seller will have delivered all 5 tons for 2 years and will have got the amount of money depending on tomatoes color. On the slide, we can see the differences of Salam and Istisna contracts. So the first difference is the object of contracts. Salam can be used for abstract objects such as money, stocks, and etc. Gold and silver are classified as money. It is a difference from classical. The object in Istisna, it is used for assets with accurate characteristic specifications, such as real estate or details for machines. The stages of contracts and the amount of payments. Salam is used for one-stage projects with fixed date and one payment. Istisna is used for long-time projects with many stages without fixed dates, which require several payments. The possibility to break the contract. For Salam contract, interrupting it needs the permission of all participants. Istisna can be interrupted by the desire of one participant. It's all the differences that I have found, because in English Wikipedia, in English Google, we have not a lot of information. Islamic banking. So, except of Salam and Istisna contracts, we have options contracts in Islamic banking. The names Arbun and other is Ijrar. In an Arbun transaction, a buyer makes a down payment toward the purchase of an asset at a specified price, strike price, within a specific time period. It is exercise period, in classical, in our minds. If at the time the buyer wishes to buy the asset, the market price of the asset is first option. If the price is higher than the strike price, Then the buyer will conclude the Arbun transaction by paying the balance of the strike price. Second option is if the price is lower than the strike price. Then the buyer will elect not to conclude the transaction and the seller will keep the deposit. A buyer wants to get, so I have also the example with farmer and buyer. A buyer wants to get tomatoes by $10 per ton through 2 weeks. He pays a deposit in $2 per ton, which was set by the farmer. Now they define that the buyer can buy tomatoes for $10. After 2 weeks, he can have one of two events. First event, tomatoes will have been cost $10 and more. Then the buyer will buy tomatoes and will pay a price equals actual price minus deposit. So $10 minus $2 equals 8. The farmer will get $10 of loss and $10, and his loss will be equal to $10 minus actual price. And second event is that tomatoes will have been less than $10. The buyer will not make to buy tomatoes because he won't buy because the price is higher than the market price and will lose deposit. The farmer will get $2. After these events, the farmer will recalculate the new deposit and to suggest it to the buyer. He can refuse or accept. If he accepts, the cycle will have been repeated, else the deal will have been finished. Ijrar is another type of options in Islamic banking. So Ijrar means the purchasing goods time to time in different quantities. In Islamic jurisprudence, Ijrar is an agreement where a buyer purchases something from time to time. Each time there is no offer or acceptance or bargain. There is one master agreement where all terms and conditions are finalized. All these instruments are constructed on the Wa'ad principle. Wa'ad can be translated as promise. In all these contracts, participants promise each other your condition. It exists the next requirements for Wa'ad. First requirement, it must be unilateral. Second, it must have cost the promise to have incurred some costs or liabilities, because the Wa'ad cannot be empty. It doesn't work any otherwise. Third principle, if the promise is to purchase something, then the actual sale must take place at the appointed time by the exchange of offer and acceptance. Mere promise itself should not be taken as the concluded sale. Fourth, if the promiser reneges, the court may force them to either purchase the commodity or pay actual damages to the seller. The actual damages will include the actual losses suffered by the promise and will not include the opportunity lost. Thanks for your attention.
Well, Vladislav, first of all, I tell you what I like. I like that you did this thing, this presentation about Islamic finance, because many people do not consider it, and instead is something very important. Instead, especially for the future. And also, I lived there in those countries for a couple of years, so I appreciate it. So regarding your presentation, then there is something on the style. If you present again.
New presentation?
Yes.
Okay. Yes.
So go the second slide. Second. This one. Can you see the red can be
Can you repeat, please?
the red in the center? The red text. It's difficult to read. It's clear?
Okay, yes.
And also go to slide number 5. This is good, but you put a lot of text in a slide, and then the text often is small. So it's better if you increase the size and you.
Okay, I can try.
No, don't change anything. It's just a suggestion. Vladislav. Stop.
Yes.
Don't worry. It's a suggestion. And then when you make a presentation, you mention that 2-3 examples. Put the examples as well on the presentation. Yeah. Vladislav, can you follow me?
Yeah. Please, can you repeat, because I have a very worse connection, Wi-Fi connection.
Arina, can you say it to Vladislav? Maybe you have better connection. Maybe you can say in Russian.
Excuse me, what should I say?
I said to him to avoid to have big small letters on the presentation, and the other thing that I said is to report examples in the presentation, because then it's easier for people to follow his examples.
Окей. Влад, мы попросили вроде сказать на русском. Первое, то, что плохо, что много текста. Второе, что нужно примеры на слайд выносить, чтобы было понятнее, о чем ты говоришь.
Я понял.
Okay, good. So that's it. I don't have any additional comment for you, Vladislav. Okay? Okay.
Can I close the
Next one. Elvira, did you send me the presentation? Did you present it? Because I don't find it.
Yes, I have sent it to you for both emails.
Can I fastly show my screen that I sent you my email?
Okay. Let's with Tanya.
So here.
Elvira, when did you send it? Sorry.
This is the message I sent you on the 6th of October.
Just a second.
Now, the next one is that I'm forwarding it. Just a second, it will download. In here, 701, I forwarded this message to this email. And this is the one I
No, I
sent.
want to know the time. So the 6th at 16:48. Because then I can retrieve it. Is your what is it in the message? Is your name in Russian?
Well, my email is in English. Tanya Yakushina.
Because I can't find it.
Well, here are the email I sent it to.
Could you, yes, just copy and paste here on the chat your email.
Okay.
Because then I can look for it. And Elvira, also for you, because I cannot find your presentation.
I can't add anything to the chat here. I can
You
only
cannot?
write. Okay, I'll just put it on a Google Drive and then send you a link. Just a second.
But what was your email address? Tanya is T-A-N-N.
I'll write it to you in the chat.
Okay, this is what I was looking for. Elvira, can you do the same, please?
Shall I share the screen?
Yes, but I asked you to share, to send me, like Tanya did, your email address.
I did it in chat.
You did it, but I don't see it.
We see.
Now I found it, sorry. Now I found it. You're right. So, Tanya, yeah, from your side, that's all. I could find now, finally, your email.
Okay, thank you.
Elvira, I cannot. Your email is not existing.
I can share you all my presentation.
Yes,
And
please
my-
share the presentation.
так. But it's my message from 6th of October.
Oh, I found it. It was another email address. Okay, I can see it, and you can start.
Okay. I'm going to speak about pre and post trade reporting. Over time, exchange trading is becoming increasingly widespread, and in this regard, there is need to refine existing laws and their evolution. To ensure this, the Financial European Commissions, with the participation of members of the G20, made some changes to the existing directives. And from on the 3rd of January in 2018, the second directive on the market of financial instruments and the regulation on the market of financial instruments came into force. The principle of MIFID is to create a strong market that attracts investors, which is possible only with full transparency on transactions on the stock exchange. All commodity trading venues regulated under MIFID second and MIFIR, the financial instruments traded in the European Union, are subject to the pre-trade transparency obligations. Pre-trade transparency is designed to provide market participants with a near real-time broadcast of basic trade data around firm quotes. Operators of trading venues are required to make public current bid and offer prices, the depth of trading interest at those prices, and actionable expressions of interest which are advertised through their systems. Post-trade information for derivatives must be made public as close to real-time as technically possible. The maximum permissible delay is 15 minutes for 33 years after FA came into force. After that initial period in 2020, the maximum permissible delay was reduced to 5 minutes after execution. Information should be published close to the maximum time limit only in exceptional cases where available systems do not allow for publication in a shorter period of time. The details required to the NIT and MFI are public. For instrument identification are code type, quantity measurement unit, and price notations, notional amount and notional currency, quantity measurement unit, type for emission allowances and emission allowance derivatives, and transaction to be cleared for derivatives. Eliminating the problem of non-transparency of trade is a necessary condition for the functioning of the market. After all, earlier in 2007 to 2009, for example, due to the lack of transparency, standardization, and accounting for transactions, market participants and regulators were unable to timely assess the risks and real aggregated positions in OTC derivatives. These factors, taking into account the high concentration of the market and the deep interconnection between the participants, had a devastating impact on the global financial and economic system, revealing the need for integrated interaction between countries on the regulation of OTC derivatives markets. And it's all.
Okay, let's start from the beginning. Slide number 2. Full screen, please. And what about this directive? Why it was issued?
Because the previous one was maybe because market is always developing, and the previous one was too old to use it.
It's something that you mentioned in your slide, no? In your presentation. But then, in which way you create a strong market?
To develop pre-trade and post-trade transparency.
Okay, and what do you mean by pre-trade and post-trade transparency?
When participants in the market have information about have full information about the market transactions.
Why we need transparency?
We need transparency to the investors need transparency to know something about bids, volumes, prices, to make right decisions.
Tanya? Tanya?
Yes.
Why we need pre-trade and post-trade transparency?
The transparency requires different prices.
Kirill?
As I understand, we need transparency to avoid cheating of the market. So then some, I don't know.
So, right.
For example, one person may sell some asset for his friends for cheaper price.
Yeah, exactly. That is the thing. So let's say that I'm a fund manager, then I can damage the fund for the benefit of one of my friends, and then I sell at a lower price something that is worth more. This is an example. It's clear. My example is not.
Can you repeat, please, it?
Okay, good. So, Elvira, you asked for this, no?
Yes.
Okay. So let's say that I'm a fund manager, and then I do you know what is a fund?
Yes.
Okay. And then in my fund, I have General Motors, and General Motors are worth $50. I should sell or buy at that market price. Yes?
Yes.
If I sell at lower price, or if I buy at higher price, it means that I'm damaging my fund. It's clear?
Mm-hmm.
And if I damage my fund, it means that could be that I have a deal with someone else in order to get the benefit of it. Because I should sell or buy at that around that value. So pre-trade, post-trade. So that post-trade is about the execution. So what you have to show is the record of all the negotiations, and you have to show as well that the negotiations were made at the market price, not at lower or higher price. So is this clear?
Yes.
And then, Elvira, I was talking about the presentation, but the thing is over, so the class is over, and then that's fine. So we will meet for the exam, correct? This is the last class. Do you have questions?
And on the exam, we should be with our cameras on, with our and with micros on or off.
Yes. You cannot do the exam in in a normal classroom.
Some person, no. Usually, if exam is in class, teacher in instruction book the room, and he conduct the exam in person in the room. So somebody need to book the room in HEC.
Okay. Because someone should be there, and this is my idea, that someone should be there, and then you have to do the exam in person, not at home. So I will try to contact someone that's exactly there. So the exam should be about 1 hour, and then you will get some exercise and questions, theoretical questions. And then, yes?
The exam is open book or closed book?
No, it's closed book. You have to know what you said. Yes?
And what generally to expect from exam? Like some problems, some theoretical questions?
Yeah, you will have both. So, for example, definition. What do you mean demo here?
Maybe some demo version of exam.
Trial. version.
Yeah, I can prepare a demo version, but essentially, you know what I'm asking, no? So I want to know definitions, like, for example, liquidity. You need to know what is liquidity. You need to know what is an asset. You need to know what we mean by operational risk or liquidity risk, or what is a CCP. So, you know, all the things that we have done together. Questions?
Okay. And about problems, so we will have to solve some of them.
Yes, for example, we did together something regarding breakage shows, no?
Yes, but we won't have any Excel at hand for sure. So
No, you don't need Excel for that. Then
we need to
you
compute.
need just a calculator.
We need to compute a normal distribution. It's pretty hard by hand.
No, you will not do it. You will get a table, and then you will use it. You know, there are tables of the normal distributions.
Yes, okay.
So we need to bring them by ourselves.
Yeah, but I can send to you as well.
Okay.
And when will we get marks for the course the part of the course that was before the exam, for presentation, essays, and participation?
Yes, by the end of this weekend, because today was the last one, no?
Actually, there is a problem. I haven't told you my presentation yet. I guess I'm the only one. Yeah.
I'm sorry. So, Nick, do you have time today, or you want to do it tomorrow?
I definitely don't have time tomorrow, so I'll better do it today.
Okay, so after this this discussion, give me 5 minutes, and then we'll start with your presentation.
Yes, okay.
Okay, good. So who else is missing? Only you, Nick. Sorry.
Yeah,
You
I
are the
guess
last
so.
one. Because I can't see you there. But I'm sure that you sent it.
Yes,
Well,
I sure did.
Yeah, I'm sure. Okay, so other questions? No? Okay, so give me 5 minutes. The ones that can stay or want to stay, of course, free to stay. I will be back in 5 minutes, okay?
Okay.
Hello? Hello?
Yeah, sorry. Forgot to turn on my micro.
It's okay. So, I'm trying to retrieve your presentation. When did you send it?
I sent it on the 6th of October.
And do you remember what time?
What time? Give me a second. I can check it. It was 7:58 on St. Petersburg.
In the
So
morning.
yes, the morning.
Can you copy and paste your email here on the chat?
Yeah. My email on chat. So just send it to you again, or what?
No. Email address.
My email address. Okay.
Yes.
I used my studies one, so this one.
Because some didn't arrive, or some yes. I remember that I've seen yours.
Yeah.
Just a second.
Okay.
Okay, got it.
So you have it, right?
Yeah, thank you. No, but I remember that I got it.
Yes, okay. I see.
So you can start.
Start. Okay. Give me a second. Just a second. Yeah, okay. So I can share my screen, I guess. Where is it? Yeah. All my screen. Here is my screen. Here is my presentation. It's pretty short, simple, but I guess it should work. Okay, today I'm going to present a review of topic of value at risk. The problem of risk management is an old one in statistics, economics, and finance. Financial risk management has been a concern of regulators and financial executives for a long time as well. So, retrospective analysis has found some war-like concepts in the history, but war didn't really emerge as a distinct concept until late 1980s. So the triggering event was the stock market crash of 1987. This was the first major financial crisis, which was so unlikely according to existed statistical procedures that financial markets just didn't expect it at all. It resolved into a broad discussion about rare crises, which were called black swans. So, if these crises were included in the analysis, they dominated results and led um, to strategies that didn't work in short term. So that didn't work day to day, only in the long run. If these events were excluded, the profits made between black swans could be much smaller than the losses suffered in the crisis. It would have made the whole financial activity aimless and hopeless. So VAR was developed as a systematic way to segregate extreme uh, events, which are studied qualitatively over a long-term history and broad market events from everyday price movements, which are studied quantitatively um, using short-term data in specific markets. Following this idea, J.P. Morgan published the methodology and gave free access in 1994. In 1997, the U.S. Securities and Exchange Commission ruled that public corporations must disclose quantitative information about their derivatives activity. Major banks and dealers chose to implement the rule by including VAR information in the notes of financial statements. As a term, value at risk is a measure of risk of loss for investments. It estimates how much a set of investments might lose with a given probability. Given normal market conditions, in a set time period, such a day. It's mainly just written that way, that like value at risk daily. And below you can see the mathematical expressions for value at risk. On this slide, VAR is demonstrated on the distribution along with estimated shortfall. So, talking about estimated shortfall, it is important to mention some other terms related to VAR, as well as explain the estimated shortfall itself. So, active VAR. This is the difference between the assets and the liabilities. If the portfolio is perfectly immunized, active VAR will be nil. The higher the active VAR of a portfolio, the greater the portfolio's exposure to market risks. Conditional VAR. This averages all expected losses greater than VAR, and it is also known as expected shortfall, which was demonstrated above, or tail loss. If VAR is calculated and at a 99% confidence level, conditional VAR averages the worst 1% expected losses. Marginal VAR. This is a measure of a change in VAR at the aggregation level when an instrument's position is increased by 1% or unit. It helps to optimize the risk return profile of a portfolio. And finally, partial VAR. So a measure of the change in VAR at the aggregation level when an instrument's position is completely removed. This helps clients to understand the contribution to aggregated VAR. So, summing up, is VAR a decent approach or just a rudiment of the economic thought born in crisis times? It is a widely discussable question. Supporters of VAR as a preferred risk measure claim that it is, first of all, plain, so doesn't represent some kind of black box. It's just a quantile, and it doesn't require any strong assumptions. It is still just the result of mundane statistical procedure. Thus, it's easy to compute. And finally, it is defined for all businesses, so it's really flexible to any kind of data. At the same time, critics claim that VAR has some serious problems. So, claimed to estimate the risks of rare events, which is almost impossible. Well, from the statistical point of view. And also, it gives false confidence, stating that hits are unlikely to happen and assuring that they won't be too high. In reality, it doesn't always hold. And additionally, in practice, the concept of VAR is often abused. First variant is that we assume that plausible losses will be less than some multiple of VAR. It's not true. They could be much greater. And reporting a VAR that hasn't passed a backtest, it's just incorrect not to check someone's assumptions on actual data. It's the open field for manipulation. Yeah. And in conclusion, balanced consideration should be taken before relying on VAR in the financial sphere. Nevertheless, while used properly, it demonstrates promising results achieved in an instance thanks to modern processing technologies. That's all I wanted to say. Thank you for your attention.
Nick, thank you for this presentation. I have a couple of comments.
Mhm.
First of all, the topic of this class is derivatives, no?
Yes, yes, it's true.
And then you expose something different.
Actually, I took a topic from your.
Yeah, but that is related to derivatives. So let's go back to your presentation. It's fine. Go down.
Okay.
So you have to make an example regarding derivatives, for example, not about bar. So the issues that we have with bar when we deal with derivatives, no? And then just a second, don't move.
Okay.
Go back to the previous slide.
Yes.
Okay. This is more or less a normal distribution, no?
It's not really a normal distribution, but it's not some kind of shifted one. Yes.
Okay. So this more or less is a normal distribution. The thing is that you cannot show what the real difference between the bar and the expected shortfall if you have a more or less the distribution, a normal distribution, because the expected shortfall then, I tell you, is more or less 97.5% bar. If you compute 97.5 bar, you will get more or less the same value of the expected shortfall.
This wasn't really to show the difference. It was just to illustrate on the graph how they look like. And well, yes, that the bar is just the some kind of level, while shortfall it is the mean value, and
Yes.
bar is just a quantile.
Yes, but then you can appreciate the difference if you have something that is not normally distributed. This is what I wanted to say.
Yeah, maybe. I do not think of normal distribution is just the example of one of my tasks on actual data, and it wasn't really normally distributed, just a coincidence. I guess.
Yeah, but more or less is that one. What do you do? Which kind of work you do?
We had a course in which we discussed risks.
Okay, that's why you did a kind of recycle of your slides. That's fine. Then another thing. When you mention something, it's better to provide, first of all, the definition. You start with the definition, so by bar, I mean this, by expected shortfall, I mean this, and so on. And then you talk about that thing, no?
Yeah.
So,
yes.
Yeah. So, for example, here you present the expected shortfall, but you define it later.
Yes, it's true.
Yeah. So that's fine. So the presentation is okay, and the remarks that I wanted to give you, what I said. So do you have questions for me?
No, not really.
Okay,
Everything
good.
is okay.
Okay, good. So then I already sent to you and your colleagues the table that you for the normal distribution that you can use.
You sent what? Sorry.
The standard normal distribution.
The tables.
Yeah, you
Yeah,
can find
okay.
anywhere on the internet. But what I sent, you can use that. You can use anything else. It doesn't matter. So from my side, that's it. I will. And regarding the the marks to you and your colleagues. I promise to send them by the end of this week. But question, you will get marks from the other professors all together or individually?
You mean, yes, we usually get just the common table for, yes, for everyone. So it's not a huge mystery who got what. It never was.
Understand it. But one matter is if you want to disclose your mark. Another matter, if I disclose it, it's completely different.
Well, in HEC, professors usually just send out us the common table, so it's just full disclosure from the start. We are, I don't know, we got used to it. We not sensitive to this kind of
Okay, that's fine.
disclosure.
So I said that 20% would be attendance, 30% would be what you have done, and the rest, 50% would be the exam, correct?
Yes, as I remember, it's something like that. Yes.
Okay, good. So then, of course, if you have questions, you may ask. Then regarding the marks, again, the only thing that I must be sure is I need to talk to Professor Sergei Kura. Sorry, because with the Russian names, I'm a little bit lost.
Yeah.
He's
Can
the
imagine.
responsible of the course, Sergei Kokov.
Yes, Sergei Kokovin. Yes.
Kovian?
Yes. Yes, it's a tricky Russian surname.
Kovian?
Yeah, something like that. Yes. Yes.
Say it again, please, because I'm
Kokovin.
Kokovian.
Yes, Kokovin. Yes.
Kokovian. Kokovin or Kokovian?
Kokovin. In.
Kokovin.
Yes.
Kokovin. Okay.
Yes.
Kokovin. Okay, now.
Yes, okay.
Okay, thank you, and have a nice evening. Bye-bye.
Yeah, thank you. And just
Sorry.
one more question. So, are you planning to send any trial exam or just?
Yeah, I will try to do it because in this way you can do some exercise.
Yes, it's true. Will be more prepared in this case for the exam.
But
Yes.
regarding exercise, you have an Excel spreadsheet, correct?
Yes, we have it.
Okay, so what you can do there, apart from the normal distribution that I sent you the table, you change a value and you get an input, for example, and you get a different output. So you can do as many trials as you want.
Yeah.
Yes?
Yes, it's true.
You just change one, 2, 3 values and you get a different result.
Yeah, but we'll have some other tasks apart from.
No, I'm talking about exercise.
Yeah, I understand. Yes,
So
okay.
regarding exercise, you can do by yourself infinitive number of trials.
Yes, okay. But yes.
Regarding instead the other parts, so yeah, you will get the questions that often I ask during our class. So,
yes, but about Black and Shores, it should be noted that we won't have Excel, so we'll compute it by hand, right? So yes, okay.
Or with the normal calculator, not the ones that.
We'll better use tables, not everyone's calculator can do normal distribution. For example, mine can only do, I don't know, exponent, but not other things.
A normal calculator is fine.
many of us don't have it. So if you just, well, we'll just use the table in this case.
Yeah, so many of you don't have a calculator.
We have a calculator, but
Normal.
yes. Well,
Yeah.
it can multiply, it can sum, but it can't calculate the normal distribution. Yes.
Exactly. This is what you can use.
Yes. Yes. Okay.
So,
I will say it to my colleagues. Yes. Okay.
a normal calculator is fine.
Yes. Okay.
And
Thanks.
regarding the normal distribution, you have the tables.
Yes.
You
Okay.
don't need a calculator, okay?
Okay. Thanks.
Again, exercise, Excel.
Okay.
You do as many trials as you want. And then regarding the rest, you will get theoretical questions. Okay?
Yes. Okay. Thank you. Goodbye.
Good evening.
You too.